Massachusetts, like just about every state, is collecting way more in taxes than it did in previous years.
There is a potential opportunity in Massachusetts to lower your tax burden and put more money back into your pockets.
That's great news.
2 ballot initiatives have been filed with the Attorney General's office. One seeks to lower the personal income tax rate from 5% to 4%. The other involves expanding Chapter 62F and the return of surplus tax collections back to the taxpayers.
I earned this money.
For a breakdown of these 2 initiatives, Executive Director Paul Craney spoke with Jared Walczak, Vice President of State Projects at the Tax Foundation.
It is a 1 percentage point reduction for everyone, and I think that's the right way to go here. It's important to put this in context too. Every state, including Massachusetts, has vastly higher tax revenues, even after adjusting for inflation, than they did 3 years ago, 5 years ago, 8 years ago. It joins the majority of states in trying to do something to provide tax relief, and it does it in a way that does, because it's focused on the marginal rates, does help the economic competitiveness. I think there's ways to go even beyond that, but it's really a move in the right direction to be thinking about how can you do rate reductions, and I think it provides real benefits for all taxpayers.
I want to talk about another ballot question that is being proposed today too. It's a little kind of complicated, but it's called Chapter 62F.
Oh.
It's basically when the state collects too much tax revenue, taxpayers get a refund.
Yeah, so this is in a broad class of what we call TELs, or tax and expenditure limitations. Lots of states have them. They don't tend to do a whole lot in most states, and that's true honestly in Massachusetts, where it's only been triggered, I believe, twice, in 1987 and most recently in 2022. It rarely, therefore, provides a credit or a refund. What it does at minimum, though, is provide sort of an upper limit. It constrains the state, constrains the growth of taxes, because if it grows too fast, you will have to return some of it. So I think that has been valuable. It's certainly valuable when it provides that refund, but even when it doesn't, it just constrains the growth of taxes overall in the state, because otherwise, if you raise them too much, it will trigger this, because it's based on wages and income, things, sort of economic factors, not on taxes in previous years. And what happened, of course, as you know, is that the surtax is outside of that. Just about everything else is in. Your traditional individual income tax, your corporate income tax, your sales tax, your excise taxes, your estate tax. Like, they are all part of this, but the new surtax revenue is outside of this. So however much it generates and all of the increases it's created, it doesn't affect the cap. It doesn't provide a refund or a rebate. I don't think that makes sense. If you're going to have this, it needs to be pretty much all of your tax revenue.
You don't want a loophole.
You don't.
Loophole.
You don't. If you're generating additional revenue, then presumably if it's growing faster than the economy, substantially faster. I mean, this is not a strict tell. This is not something that is creating lots and lots of refunds and rebates every year. I think in the last year, you would have needed more than 7% growth in a year for this to trigger. That seems reasonable to me. And this is outside of it. I think it makes sense to have the whole tax code within it.
For more information about these 2 ballot initiatives and to watch our full interview with Jared Walczak, be sure to visit our website and to follow our social media posts. The Fiscal Alliance Foundation is a nonpartisan, nonprofit 501c3 organization. Visit our website to read more about our alternative energy policy studies, sign up for important email updates, make a tax-deductible contribution, and follow us on social media.